Today we're going to talk about how to invest in stocks in the easiest and most efficient way and ultimately get the best results for the least amount of effort. Or as I like to say, stock investing on easy mode. So as we go through this, I'm going to assume that you're a complete beginner, but no matter where you're at in your stock investing journey, I can guarantee that you're going to get a lot of value out of this video. So why should you listen to me? Well, here's one of my accounts. This just shows my year-to-date performance compared to the S&P 500. So this shows that the S&P 500 has done about 12% year-to-date. And meanwhile, I've done closer to 150% year to date. Obviously, I'm not going to be able to do this every year, so I'm not trying to imply that, but I just wanted to quickly show you this just to give you an idea that I must at least somewhat know what I'm talking about. And when I talk about investing, by the way, I don't want you to get that confused with trading or speculating, or in other words, essentially gambling. I've personally never even bought a lottery ticket ever in my life. I've been to Vegas a handful of times, and you might be surprised to learn that I never even gambled while I was there. Okay, so if you're still watching this, then you're my ideal audience, and if you wouldn't mind, please give this video a thumbs up and consider subscribing. Okay, so we're talking about the easy mode way to investing. And the good news too, by the way, is that if you use the information that you're going to get from this video, even though it basically requires zero effort from you, there's still a very solid chance that you're actually going to do much better than all those people out there trying their very hardest to beat the market. So speaking of outperforming the market, that leads me to the first thing that I want to cover with you, which is that if you've heard people talk about the market or trying to beat the market, they're usually referring to something called the S&P 500. The S&P 500 has more or less come to be considered the market. It's the benchmark that everyone compares themselves to, and it's what a fund manager's performance is compared to. Okay, so all the S&P 500 is just a label that has been put on this group of stocks. It's also referred to as an index of stocks. So the S&P 500 is an index of 500 stocks. And there's other indexes too, a whole bunch of them. The other most known ones are the Dow 30, which consists of 30 of the largest US companies that are also nationally recognized, well-established, and financially sound companies. And then there's the NASDAQ 100, which consists of the largest 100 companies that are listed on the NASDAQ stock exchange. So those are just three of the most popular ones, but none of this stuff about indexes is all that important for you to memorize or anything like that. All I really need you to take away from this first part is that there's these things called indexes, and that an index is just a label that has been put on a group of stocks. An individual company, by the way, could be in all three of these indexes that I just mentioned. Apple, for example, is in all three of these indexes. So why have I started off by telling you all about indexes? Well, depending on how new you are to this whole investing thing, you may or may not have already heard the advice to basically just buy index funds, and that's basically all you gotta do. Just buy index funds on a regular basis and then just forget about it. Come back in 30 or 40 years and you'll have yourself a nice profit. And this is actually not horrible advice for the vast majority of the population. However, there's a few caveats to this though that should be mentioned, and there's also a couple details that often get missed, which we're about to cover. And then I have for you what I think is an even better alternative, but you can take your pick once you have all the information. So those people that would suggest that you just regularly contribute a consistent amount and on a consistent basis towards buying index funds, well, they would tell you that on average, the stock market has historically returned about 10% annually, which means that all you need to do is contribute, say, for example, $500 a month, so $6,000 per year. And then after 40 years of that, your net worth will have grown to approximately $2.6 million. Anyone who would have done this over the past 40 years would have achieved this exact result. Not bad for never having needed to even think about the stock market or read a company's annual report or watch news about the stock market or any of that. All you had to do was believe that over time America would continue to prosper and grow. Interesting, that sounds pretty easy. So with all that said, I think now would be a good time to go ahead and buy an index fund together. That way you can see what it visually would look like to buy an index fund. Okay, so I'm gonna buy one share of the index fund VOO, or VOO, however you prefer to say it. Okay, so we'll search for it, and then now that we found it, I'm gonna hit buy. And then since I don't pay for real-time market data, just because I don't need it for what I do, I'm gonna hit snapshot here, which is gonna show me the current trading price. Okay, so I'm gonna change my quantity to 1, and then we're gonna select limit order, put that in, and now swipe to buy. And so now it tells me my order was filled right away. And then on this next page here, I can see now this is the position that I have, and it tells me that I got in here, I got filled at $333.67 for that one share that we just bought. It cost me $1 to do that, so that's why it shows me as being down by $1 here. Okay, so what we just bought together was an S&P 500 index fund by Vanguard. Vanguard is the name of the fund management firm. And there's a lot of asset management firms that have their own S&P 500 index fund. So Vanguard isn't the only one. However, Vanguard is known for having the lowest expense ratios on their funds, which just means that it has the lowest fees. We could have bought the SPY, which is a fund that does the exact same thing. It just tracks the S&P 500, but the expense ratio fee on the SPY index fund is slightly higher than the expense ratio for the VOO index fund. 0.03% for the VOO index fund versus 0.09% for the SPY index fund. And since both these funds do the exact same thing, well, we might as well choose the cheaper option. I am going to talk about expense ratios a little bit more in just a sec, but first let's talk about actually what we just bought. So we purchased a share of VOO together. And what does that mean? Well, it means that we now own a very small amount of each of the companies that are included in the S&P 500 index. So we now own a little bit of Apple, we now own a little bit of Microsoft, we own a bit of Amazon, Facebook, Google, Berkshire Hathaway. We're officially part owners in all 500 of these companies. That's all these index funds do. As new money flows in, the fund manager buys shares of these stocks in the correct proportion so that the fund maintains the proper balance of ownership in all these companies to simply just match and track the S&P 500 index. So the fund owns the shares of stock of all those 500 companies, and you own the fund. So through the fund, you own those shares of stock. So you could go tell your friends right now that you own Apple and Microsoft and 498 other awesome companies, and you'd be telling them the truth. Okay, great. So when you buy these things called index funds, when you do so, you're spreading your money out over 500 different companies instead of concentrating your money into one company. Cool. Simple enough. So why is this advice to just buy low-cost index funds and just hold them for 30 or 40 years? Why is it so popular? Well, we've already looked at how your money could grow by simply contributing consistently on a regular basis for 40 years. Remember, we said that 500 per month, or in other words, 6,000 per year, growing at 10% per year for 40 years would turn into $2.6 million. So that's really the first reason this advice is so popular, is just because it's so simple and takes such minimal effort. Another reason why it's such popular advice is because, well, let's look at the alternatives. Alternative number one is to pick stocks ourselves. And this, of course, is going to take a lot more effort. And to be honest with you, as someone who's dedicated years now studying this stuff, you do have to have a real passion for business, and you have to actually enjoy reading financial reports. And if you don't, just like with anything in life, if you don't enjoy it, you're going to end up putting it off and really just never getting to it. And it's going to be a lot harder to get good at it if you just don't enjoy it. And as I mentioned earlier at the beginning of this video, a lot of people that pick their own stocks in an attempt to beat the market actually don't end up even succeeding in doing that. Okay, so another alternative to just buying shares of an index fund and forgetting about it is to, instead of buying an index fund, buy an actively managed fund instead. However, this alternative is not too appealing either. Unlike an index fund that is dedicated to simply tracking and mirroring an index, an actively managed fund has a fund manager that is actively handpicking the stocks that he thinks will do better than the others. The actively managed funds are attempting to beat the market with their expert stock picking skills. Historically though, people have been much better off just buying index funds. Just take a look at this little scorecard. Let's just look at the second line, all large cap funds, which is being compared to the S&P 500 index. And if we look at the results over 15 years, we can see that 86, almost 87% of funds did not outperform the S&P 500 index. So chances are the actively managed fund that you would end up picking if you were to go this way would also not outperform the S&P 500 index fund that you could have just bought instead. So passive indexers have historically beat the active stock pickers on average. The truth of the matter though is that the real reason behind this underperformance of actively managed funds compared to the S&P 500 index is that these funds have high expense ratios. Some of these actively managed funds have expense ratios in the 1, 2, and 3% range. Remember the VOO index fund that we bought earlier? Well, it had an expense ratio of 0.03%, practically nothing, which is a huge difference between that and 1, 2, or 3%. And by the way, if the extent of your current investments is some mutual funds that were sold to you by some financial advisor, then this is probably you. 1, 2, or 3% might not sound like it's all that much, but it's actually massive. The expense ratio is a percentage-based fee that is deducted from the fund's total assets. It's not a once a year thing on a particular date, but rather it's every single day. So if you invested $100,000 into a fund that had a 2% expense ratio and that fund produced a 0% return, well, rather than still having $100,000 1 year later, you would actually have slowly watched your $100,000 become $98,000 because of that 2% expense ratio. Ouch. The longer you let this go on for, the more money that is getting gobbled up by these fees. If this hypothetical fund with a 2% expense ratio earned 10% in a year, well, your personal return after the expense ratio would be 8%. Look what happens if you carried on like this. Starting with $100,000, the difference after 10 years isn't that noticeable, but after 40 years, that 2% fee has resulted in you ending up with less than half of what you could have without that fee attached. So whatever you end up doing, just keep an eye on that expense ratio fee because it's really going to add up over time. If right now you're one of these people who have all their money invested in some mutual funds, I would suggest you go take a look for yourself what the expense ratio fee is that you're paying on the funds that you're currently invested in. All right, so let's get back to the subject of index funds. And you'll remember that I told you that although I do still think it's a great strategy for most people, there are a few extra things that you need to know. And I also want to tell you still my preferred alternative that I believe is equally as easy, but in my opinion, even better. But before that will properly make sense, there's a few other things you need to know about index funds. So when you buy into an S&P 500 index fund, we've already established that it means you now own a small portion of 500 different companies that make up the index. But those 500 companies are not equally represented within the index. Apple, for example, is weighted at 6%, Microsoft 5%, Amazon 4%, etc., etc. So when you buy an S&P 500 index fund, your money is not being equally spread out over these 500 companies. Here's a visual representation of how your money is being allocated when you buy in. So obviously the names of all 500 companies won't fit onto this little pie chart here, but nonetheless, the main takeaway from looking at this should be that almost a quarter of the money you're investing when you buy into an S&P 500 index fund is going towards the top 7 or 8 companies of the 500. And another thing you'll be surprised to learn is that the S&P 500 index is actually a lot more actively managed than most people realize. The stocks that make up the S&P 500 index are picked by a committee. So it's not just the largest 500 companies. And it's also not some sort of computer algorithm that determines which companies are included. There's a few criteria and requirements that must be met, but at the end of the day, it's a committee of people that decide which stocks go into the S&P 500. So bottom line, it's people picking stocks. And their goal when picking these stocks is to pick stocks that best represent the largest US companies. So a lot of the success of index funds is actually attributable to the lack of expense ratio and not necessarily due to superior stock picking. That being said, the S&P 500 committee of stock pickers has definitely done a great job historically, but as we all know, past performance does not guarantee future results. So regardless of the fact that the stocks within the S&P 500 are picked by a committee, the low-cost index fund approach nonetheless is still a very good way to go for the majority of people. But now I need to quickly warn you about a mistake that most people will make while attempting to employ this strategy that will cause them to ultimately fail, and they'll wonder, oh, how did this happen? I thought I was doing the strategy. The best example to use to illustrate this point is Peter Lynch's Magellan Fund. Over a 13-year period, this fund achieved an annualized return of just under 30% per year. So naturally you would think that the average investor in that fund must have done quite well. After all, 30% over 13 years would turn $10,000 into $300,000. But the average investor in the Magellan Fund actually lost money. And it's because of a phenomenon called chasing returns. People who chase returns will sell out of their stock or funds after it has been recently performing poorly. And then they immediately put that money into stocks or funds that have been recently performing very well. But ultimately what's happened here is that these efforts to chase returns have made them sell at the exact worst time and buy at the exact worst time as well. So the two key takeaways for you here are, one, yeah, don't chase returns. Buy, and then don't be tempted to sell just because it's gone down a bit. Remember, we have a 30 or 40-year outlook. You should not be watching the daily movements of your portfolio or even the yearly movements of your portfolio. The easy mode method is truly set and forget. The second key takeaway here though is that if you're going to take this easy mode approach that we're talking about, you're not going to want to dump all your money in at one time, like once per year or something like that. That would be bad because your timing could potentially be not ideal. So rather instead, the best thing to do is figure out a budget of how much money you could consistently invest, an amount that you would be okay with putting away for 30 or 40 years. So figure out how much money that could be for you. And then every week or every other week, whenever you get your regular paycheck from your employer, immediately put that money into your investment account and buy your shares of your index funds. 10% of your income is a great amount to start with. And if you think that's too much, just realize that there are people currently out there living on 90% of your current income. So it is possible. possible. And again, just buy and then leave it. If you're gonna go into it with this plan and goal, then there's no point in checking the stocks on your phone all the time. That's just gonna stress you out and cause you to potentially do something silly. The best way to not do something silly is to not even look at it. And by contributing a consistent amount regularly, you will protect yourself against bad timing. This is also referred to as dollar cost averaging. Okay, so some of you might be wondering, what about when the stock market is extremely and very obviously overvalued? Should I be waiting until the market comes down? I can see why you might want to ask this question, but the problem with trying to time the market like this is that it just doesn't work. If you were to stop doing your regular contributions that we just talked about because you think that the market is too high and so now you're gonna wait until there's another market crash or something like that to start buying again, well, the next question becomes, what are you gonna do with the money in the meantime? If you put your money into a savings account in the meantime, earning 2%, for example, inflation is gonna destroy the purchasing power of that money. If you don't fully understand what I just said about inflation, by the way, go check out this video right here. It's very important that you understand this, even more important than what you're learning in this video right now. Oftentimes, serious market run-ups that have you thinking, wow, these stocks are expensive, well, it often coincides with periods of very high inflation. So by staying in cash during these time periods, it's actually going to really hurt you because the value of your money is getting destroyed by the effects of inflation. And you might end up waiting a long time and end up missing out on a lot of gains while the market is taking off and you're sitting in cash just waiting. Ultimately, if you're going to try to time the market like this, then you're going to get the same failed results as those people trying to chase the market like we just talked about. If the stock market were to be extremely high and just very overvalued for a long sustained period of time, then it might mean that your annual results will be closer to 3 or 4% per year. But under those circumstances, there really wouldn't be any better alternative for your investment capital anyways. So you'd still be better off by following this easy mode strategy than your friend who cashed out and put their money into a savings account instead. Real estate prices would similarly be overvalued in these circumstances as well. So once you realize that there's no decent alternative, you come to the conclusion that just staying in the markets is probably still the best way to go. Okay. So now I want to tell you about an alternative to low-cost index funds. I still love the low-cost index funds way to go, so don't get me wrong, but here's the alternative easy mode way. Alright, so one of the companies within the S&P 500 is a company called Berkshire Hathaway. Now, Berkshire Hathaway is a very unique company compared to the other companies of its size because Berkshire Hathaway is a conglomerate of a whole bunch of businesses. Berkshire is famously known as Warren Buffett's company. Warren Buffett roughly owns about 18% of the economic interest of Berkshire Hathaway, and he's also the CEO and chairman of the company. Historically, going back to 1965, Berkshire has achieved an average annualized return of just over 20% per year, compared to the S&P 500's 10% per year, with dividends included. By now, I don't even need to tell you what a massive difference there is between earning 10% per year and earning 20% returns per year, especially over a long period of time. Now, Berkshire will definitely not consistently do 20% returns over the next 55 years just because it did over the last 55 years. It actually would be almost impossible for them to achieve that. But being that Berkshire is a conglomerate of many businesses, both wholly owned businesses that have been purchased one by one slowly over time in negotiated deals, as well as partially owned businesses that have been accumulated over time through the means of buying shares of publicly traded companies just like you or I could do. This fact makes Berkshire kind of similar to an index fund in a way. And by that I mean when you use your money to purchase Berkshire Hathaway stock, you're still achieving the result of having your money diversified over a large collection of businesses rather than just one business. Similar to how purchasing the S&P 500 index fund would give you that same diversification across multiple businesses. The difference though is that instead of that collection of businesses being ones that were handpicked by some committee of stock pickers assembled by S&P Global, while the Berkshire businesses, on the other hand, they were handpicked by Warren Buffett and Charlie Munger, two of the greatest investors of all time. Another thing that choosing to buy Berkshire while doing this easy mode approach has going for it is that Berkshire has no expense ratio. Any S&P 500 index fund that you could buy will have an expense ratio, albeit a small one, being that it is an index fund. Still, it will nonetheless have an expense ratio attached to it that will take away from your return slightly. This is not something you'd have to worry about with Berkshire because it's not a fund and it doesn't have an expense ratio. And then finally, the other point that makes me prefer Berkshire for this easy mode strategy is that the structure of it being a company that owns many businesses versus being a fund does have some structural advantages for you as an investor beyond just the lack of there being an expense ratio. There's a few, but one of them is that they have the option to buy back shares of their own stock when they can see that it's priced at or trading for on the stock market at a price that they feel is less than it's actually worth. And when a company you own buys back shares of its own stock during a time that the share price is undervalued, it's actually a great thing for you as a shareholder, because when they buy back shares and reduce the total number of shares outstanding, it means your percentage of ownership increases because now you own a larger portion of the total shares outstanding. Here on this channel, I've made a bunch of videos that are geared towards the investor that does want to pick individual stocks themselves. So if that's something you're interested in, then I'd encourage you to check out this playlist right here.